My name's Djerriwarrh, General Manager Business Development and Investor Relations for Djerriwarrh Investments. I have with me today Mark Freeman, the Managing Director and CEO, and McNeill, Portfolio Manager within the team responsible for Djerriwarrh Investments. Mark, we've just announced our results for the financial year to 2022. What did you see as the key highlights of the result?
Well, it was a strong increase in the profit for the year. If we exclude one-off merger and demerger dividends, the net operating result was up 36% to nearly $34 million, driven by high dividends received from the companies we invest in, following a recovery in the economy and higher iron ore prices. The income generated from option income also remained strong for the year. The final dividend was increased to 7 cents per share, meaning total dividends for the year were up 25%. Importantly, this meant we continued to provide a fully franked yield higher than the market, 1.6% above the ASX 200 index yield. We also announced a share purchase plan to raise additional funds for investing.
Brett, Mark mentioned the enhanced yield and the 1.6 percentage points ahead of the market, but the portfolio performance was slightly below the market for the year. Do you want to comment on the major factors behind that?
Sure, Jeff. Yeah, the portfolio modestly underperformed for financial year 22 after a good year the year before. So the key reason at the sector level was our underweight to the resources sector, where particularly we struggled with valuations. But we've seen a number of resource stocks, particularly BHP, come back subsequently post the end of the financial year. So we've been stepping in and buying that. But the portfolio underperformed. Some of our best stocks for the year in terms of performance was Sydney Airport, which is subject to a takeover offer, Woodside Energy, we owned Atlas Arteria, toll road company. And then on the other side, some of the worst performing stocks in the portfolio included Fineos, Temple & Webster, Reece and Domino's Pizza.
And I suppose, Brett, with an option strategy overlay as well, you tend to underperform the index in certain markets anyway. And over the longer term, even though we are behind, that option overlay has worked for us in terms of the enhanced income, as we spoke about earlier on.
Yeah, it has. The option activity has been a really pleasing part of the result and really the key contributor to the enhanced yield that we spoke about. So we were very happy with the option result for the year. Just as a reminder, we enhanced the income by selling call and put options, predominantly call options, and we flexed the coverage, the call option coverage of the portfolio, really in response to how we're seeing the market, valuations, quality and the overall makeup of the portfolio.
So you talked about the option strategy. What else? It was a very volatile market for the second half of the year. What were the sort of main things that you did in terms of managing the portfolio through that very volatile period, aside from the options activity?
Yeah, sure. Well, reinvesting sale proceeds from option exercises is a key activity within the Djerriwarrh portfolio. So from time to time we will get exercised on call options that we've got and we need to reinvest those proceeds back into the portfolio. Our focus is always maintaining what we think is the right balance between short-term income and long-term income and capital growth. So to that end, we got exercised on some of our holdings in companies like Macquarie Group, Woolworths, ASX and NAB. We also sold some of the holdings within the portfolio, so we reduced our positions in Amcor and Brambles, and we also exited stocks such as AUB, Origin Energy, APA and Endeavour Group, and we were forced to sell Sydney Airport given the takeover bid was accepted there. So a lot of proceeds to reinvest at different times. The real focus was quality first, in line with our investment approach, and that balance between income and growth. So a lot of the proceeds were invested in companies like Woolworths, built back our positions in Macquarie Group, JB Hi-Fi was a new stock in the portfolio, as well as Cochlear, and then subsequently to the year end, we've been buying back into BHP at good prices.
So Mark, it was a very volatile second half of the year we spoke about. What's the outlook as you see it, particularly for dividends in the coming year?
Yeah, well, it was a volatile year. Obviously in the first half the market was very strong. We were a bit cautious about the valuations we were seeing and we pointed that out at our last update. Then the market got sold off with the fears around inflation, central banks putting up interest rates. But I guess that fall, we saw the Australian market fall around 13% from its high. The US market was down over 20% from its peak. So we were looking at that and saying, well, we're actually seeing some fairer value for good stocks. So were we jumping in not in a major way, but it did provide an opportunity for Djerri to sort of seek to rotate some of those funds as we got exercise and put them into some better value. Going forward though, we still have some caution. We think interest rates will continue to rise, and we're worried about the impact on the consumer from that. So we expect to see more volatility. From the dividend front, it has been a good period from the COVID low points, but resources we feel a little bit toppy. The market does get a lot of dividends from Rio, BHP, the iron ore producers. We think iron ore price looks a bit full. So there's some perhaps areas in the resource market that might come off, but perhaps some of the industrial companies can keep growing. So we're not expecting the sort of jump we saw last year, that's for sure. But we're sort of broadly comfortable. But there could be some volatility and perhaps some tougher economic conditions in the shorter term anyway.
So a perfect market for Djerriwarrh in some ways. Brett, have you any further thoughts in terms of what Mark provided there?
Yeah, we're really happy with the composition of the portfolio. We think the focus on high quality companies and diversified portfolio across stocks and sectors should set us up pretty well for both dividend income, like Mark said, the different moving parts, but also the option income hopefully as well.
Okay, thanks Mark, and thanks Brett for your time.
Thanks.
Okay, thanks Jeff.